Welcome back. Today we're diving into credit reporting agencies, Experian, Equifax, and TransUnion. They sound official, right? Almost like government agencies. Well, they're not. They're private companies, businesses just like your favorite online store. Their product, your financial history. Misconceptions about these agencies can harm your financial well-being, so let's break down what they really are, how they operate, and your rights as a consumer. By the end, you'll navigate the credit world with confidence. Let's demystify what these credit reporting agencies do. They're like giant data collectors for your financial life. Experian, Equifax, and TransUnion gather data from lenders, banks, and other financial institutions. Did you pay your phone bill on time? They'll know. Missed a credit card payment? It's in the file. They compile this into a credit report, a detailed record of your credit history. These agencies sell access to your credit report to businesses. When you apply for a credit card, mortgage, or apartment, the lender or landlord buys your credit report. This report helps them decide whether to lend to you and at what interest rate. It's a big deal, based on the information these agencies collect about your financial habits. Think of the credit reporting system like a pipeline. Lenders, banks, and companies feed information about your financial transactions into the system. This includes your payment history, credit limits, and outstanding balances. On the other end, businesses look for information about potential borrowers or customers. They pay the credit reporting agencies for access to your credit report. This report gives them a snapshot of your financial behavior. You're the subject of this data, analyzed and evaluated. Credit reporting agencies are driven by profit. They are beholden to shareholders, not consumers. Their goal is to generate revenue by charging fees for access to your credit report. They collect as much data as possible and sell it to many businesses. Their priorities might not align with your best interests. Their primary responsibility is to their shareholders. This is crucial to remember as we explore credit reporting. Let's relate credit reporting agencies to your local coffee shop. They brew your lattes and aim to make a profit by providing a service. Similarly, credit reporting agencies operate under a business license. When a lender checks your credit report, it's a transaction. They exchange money for information, your information. Both scenarios are based on a business-to-consumer model. The coffee shop provides a service, and the credit reporting agency provides data. Neither acts as a government agency, prioritizing your needs above their own. Imagine your coffee shop, keeping a detailed record of every cup of coffee you've ever ordered. They know your preferences, and sell this information to other businesses. Sounds strange, right? That's what credit reporting agencies do with your financial information. They collect, compile, and sell data about your financial habits. Your credit history, loans, and payment patterns are commodities to them. They package and sell this information to the highest bidder. It's a business transaction at its core. Businesses exist to make money, and there's nothing wrong with that. But it's crucial to understand the motivations driving these agencies. They are not neutral entities dispensing financial wisdom. They are businesses looking to maximize profits, and your data is their bread and butter. This influences everything from the data they collect to how they interact with consumers. It's why they fight against increased regulation and transparency. You need to be vigilant about protecting your financial information and understanding your rights. Let's clear the air about common misconceptions surrounding credit reporting agencies. One of the biggest myths is that they are government entities. People imagine them as all-powerful institutions monitoring every financial move. This couldn't be further from the truth. Experian, Equifax, and TransUnion are private companies driven by profit. They are not accountable to the government like a government agency. This misconception can be dangerous, leading people to believe they have no power in this system. Another myth is that the information on your credit report is set in stone. People think that once a negative mark appears, it's there for life. Credit reporting agencies are subject to regulations like the Fair Credit Reporting Act, FCRA. The FCRA gives you the right to dispute inaccurate information on your credit report. You can challenge negative marks and potentially have them removed. The credit reporting agencies might make the dispute process difficult, but persistence pays off, and knowing your rights is the first step to getting an accurate credit report. The Fair Credit Reporting Act is your secret weapon in the credit reporting game. It gives you the right to access your credit report for free once a year from each of the 3 major agencies. This free annual credit report is your opportunity to scrutinize every detail. It's like a financial checkup, but you're in control. The FCRA also gives you the right to know why you were denied credit. It provides tools to protect your financial well-being. Understanding these rules can empower you to take control of your credit. Let's get down to brass tacks, your rights as a consumer. You have the right to know what's in your credit report. You can access this information for free. The FCRA mandates that each of the 3 major credit reporting agencies provide you with a free copy of your credit report every 12 months. This report is your financial report card in the eyes of lenders, landlords, and employers. It's the document they use to judge your credit worthiness. Knowing this information is crucial for protecting your credit and your wallet. Think of your credit report like a map of your financial journey. It's essential to make sure it's accurate. Even a small error can have a significant impact on your financial well-being. The right to dispute inaccuracies on your credit report is crucial. If you spot something that doesn't look right, challenge it. You have the power to demand that the credit reporting agency investigate and correct errors. This is your financial life. Don't let anyone tell your story but you. We've all been there, that sinking feeling when you're denied a loan or a credit card. The FCRA gives you the right to know why you were denied credit. They have to provide specific reasons, often referencing your credit report. Armed with this knowledge, you can address the issues that led to the denial. Knowledge is power. By understanding your rights and accessing the information available to you, you can transform a frustrating experience into an opportunity for growth. You become an active participant in your financial journey. Alright folks, we've spent a good chunk of time dissecting the credit reporting agencies, understanding their business model, and arming ourselves with the knowledge of our consumer rights. This foundation is crucial, but it's just the beginning. But let's be honest, the real game changer is taking control of your credit and building a solid financial foundation. This is where the rubber meets the road. Think of it like this. Knowing the rules of basketball is one thing, but actually getting out there and playing the game is a whole other ballgame. You need to practice, strategize, and stay consistent. So let's lace up our metaphorical sneakers and dive into some practical tips for managing your credit effectively. These tips will help you stay ahead of the game. These aren't just some vague platitudes, but actionable steps you can take to improve your credit score, secure favorable loan terms, and achieve your financial goals. Each step is a move towards financial freedom. Ready to level up? Let's go. It's time to take charge and make a real difference in your financial life. First and foremost, make it a habit to check your credit report regularly. This is your first line of defense. Remember that free annual credit report we talked about? It's a valuable resource that you should utilize. Don't just let it sit in your inbox gathering virtual dust. Open it, review it, and take action if needed. Take some time to actually review it, scrutinize every detail, and familiarize yourself with the information it contains. Knowledge is power. Think of it like checking the oil in your car. Regular maintenance prevents bigger issues down the road. You wouldn't wait until your engine seizes up to take a look, right? The same goes for your credit report. Regular credit report checks help you spot potential problems early on, like errors, signs of identity theft, or even just negative patterns in your spending habits. Staying proactive can save you from future headaches. Section 2. Credit Utilization, the Balancing Act. Now let's talk about credit utilization, also known as your credit-to-debt ratio. This is a crucial aspect of your financial health. This little guy plays a huge role in determining your credit score, so listen up, it's more important than many people realize. In simple terms, it measures how much of your available credit you're actually using. The lower the percentage, the better it is for your credit score. Think of it like this. You have a credit card with a $10,000 limit. This limit is the maximum amount you can borrow at any given time. You use it to buy groceries, fill up your gas tank, and maybe splurge on a new pair of shoes every now and then. These everyday expenses add up quickly. At the end of the month, you owe $3,000 on that card. This is your outstanding balance. That means your credit utilization ratio is 30%, $3,000 divided by $10,000. This ratio is a key factor in your credit score. Now here's the kicker. Lenders like to see a low credit utilization ratio. It shows them that you're not over-relying on credit. It signals to them that you're managing your credit responsibly, not maxing out your cards every month and struggling to make ends meet. This responsible behavior can lead to better loan terms. A good rule of thumb is to aim for a credit utilization ratio below 30%. This is considered a healthy level. So, how do you keep this balancing act in check? It's all about smart financial habits. Well, you can start by paying down your credit card balances as quickly as possible. This reduces your outstanding debt. The lower your balance, the lower your credit utilization ratio. This can have a positive impact on your credit score. You can also ask for credit limit increases on your existing cards. This can be a strategic move. This doesn't give you a free pass to spend more, but it does increase your overall available credit, which can help lower your ratio. Remember, it's all about balance. Section 3. Hard inquiries. Don't just ask, strategize. Ever wonder what happens behind the scenes when you apply for a new credit card or loan? It's more complex than you might think. Well, one of the first things the lender does is pull your credit report to assess your credit worthiness. This is called a hard inquiry, and it leaves a little footprint on your credit history, visible to other lenders. Now, a single hard inquiry isn't going to tank your credit score. It's relatively minor, but multiple hard inquiries in a short period can raise red flags for lenders, signaling potential financial instability. It suggests that you're desperate for credit, potentially overextending yourself financially, which is a risk for lenders. So how do you navigate this tricky terrain without damaging your credit score? First and foremost, be mindful of how often you apply for new credit. Each application counts. Don't just fire off applications willy-nilly. Be strategic. Instead, do your research, compare offers, and only apply for credit when you genuinely need it and are confident you'll qualify. This approach minimizes unnecessary inquiries. Another pro tip: if you're shopping around for a specific type of loan, like a mortgage or an auto loan, try to do it within a short period, ideally within a 30-day window. This is crucial. Credit scoring models recognize that consumers often shop around for the best rates, and they account for this behavior. So multiple hard inquiries for the same type of loan within this time frame are typically treated as a single inquiry, reducing the impact on your credit score. Section 1. Taking back your financial narrative. We've covered a lot of ground today, folks. We've explored the shadowy world of credit reporting agencies, exposed their profit-driven motives, and armed ourselves with the knowledge to navigate their system effectively. But the most important takeaway is this: you are not powerless. For too long, these agencies have held the upper hand, operating in secrecy and leaving consumers feeling confused and overwhelmed. But the truth is, knowledge is power. By understanding how these agencies work, knowing your rights, and adopting smart credit management strategies, you can take back control of your financial narrative. It's time to stop seeing yourself as a victim of some arbitrary credit score, dictated by forces beyond your control. You are the author of your financial story. Every decision you make, from paying your bills on time to using credit responsibly, adds a new chapter to that story. The credit reporting agencies may collect the data, but you have the power to influence that data, to shape your credit history, and to build a brighter financial future. So let's ditch the fear and embrace the knowledge. Section 2, Your Credit, Your Future, Go Be Great. Remember that feeling of empowerment we talked about earlier? That's what happens when you realize you're not just a passive player in this game. You're calling the shots, making informed decisions that align with your financial goals. So go out there and conquer the credit world. Check your credit report regularly, dispute any errors, and manage your credit with the same care and attention you give to any other aspect of your life. Remember, your credit score is not just a number. It's a reflection of your financial habits, your discipline, and your commitment to building a secure future. And the great news is, it's never too late to start making positive changes. Whether you're just starting out on your credit journey or you're looking to rebuild after some financial setbacks, know that you have the power to create the future you deserve. So, go out there, be informed, be proactive, and watch your financial well-being soar.